being impacted. We are seeing a significant front-running of imports from the U.S. That has implications for the dynamics of inflation because companies in the U.S. are building up stocks of imported goods, and that will give them the chance to smooth out the increase in prices. And obviously that will have implications for the dynamics of inflation and how the Federal Reserve is going to react into that. On top of that, countries are, as we all know, negotiating with the U.S., and depending on those negotiations, they will decide how to react in terms of monetary and fiscal stimulus. It will take some time for us to have a more clear picture of how the stimulus will play out, in particular in China, but we are seeing already some monetary stimulus taking place. So long story short, we had, since the beginning of this tariff saga started a couple of months ago, we have trimmed off 3/10 of the global forecasts or the forecast for global growth. Now we expect 2.8% global growth versus 3.1% before the start of the increase in tariffs. We are seeing a slowdown, but very contained, and we are not seeing necessarily a recession in the U.S.
Hi Claudio, this is May also joining in. Help us understand what is your view on the US economy, because we have seen several rating agencies cutting their outlook for the US economy. Even OECD has said that Trump tariff will shrink the US economic growth to 1.6%. Help us understand, are we heading towards a slowdown? Can we expect a recession in the US anytime soon?
No, we are not having a recession call. We never had a recession call. We have been trying to be very careful in our updates of the growth forecast for the US and the rest of the world. We try not to overreact to headlines. What we are having is a slowdown in economic activity. Our average growth forecast for this year is 1.5%. And if you calculate the growth numbers, fourth quarter versus fourth quarter, it would be 1%. The number comparable to the OECD number is 1.5%. They have 1.6%, so it's roughly the same view of a slowdown, but not necessarily a recession. We see consumption holding pretty well, the labor market also holding pretty well. The U.S. economy is fundamentally a service economy. Manufacturing represents only 8% of total employment. So we think that as long as middle and higher income brackets keeps robust consumption dynamics, given that the balance sheet of the private sector is pretty robust, we see the slowdown, but not necessarily a recession.
Right. Claudio, so do you see money moving out of the U.S. because of the dollar weakening? And also, how much of an impact do you see of the weak dollar favoring emerging markets like India?
We are seeing some rebalancing away from the U.S. into other markets like Europe and emerging markets, ex-China. What we need to understand is that before the tariff shock and the uncertainty shock, the global portfolios were highly biased towards exposure to U.S. assets. They were mostly overweight U.S., underweight Europe, and underweight emerging markets. We are seeing now a rebalancing, not necessarily a fire sale of U.S. assets, just a rebalancing away from the U.S. into Europe and emerging markets to rebalance the portfolios towards more neutral levels. And that is enough to explain the weakness of the dollar that we've been observing and why emerging market currencies are trading relatively well. That is explaining why, despite the fact that the Fed is not cutting interest rates, and by the way, we've been having this out of consensus call that the Fed will not cut interest rate this year. That explains why some emerging market central banks can cut interest rates despite the fact that the Fed is not cutting, and it has to do with the fact that the currencies are trading well as the market moves away from the dollar into euro and emerging market currencies. The move was probably more concentrated in other developed currencies rather than emerging markets. There are still concerns that the global slowdown could impact emerging economies, and therefore there is not that much conviction that emerging market is a great risk-reward proposition. We like emerging markets. We think that the emerging market might benefit in the coming months.
Okay, but Claudio, you said that the Fed will not be cutting rates anytime soon, but what are your expectations of interest rates in India? How much cut do you expect in the June policy, which is days away from it now? And as well as overall calendar year 2025, where do you see India's monetary policy headed?
We have 2 more cuts. Our India economist Rahul Bahoria, which is responsible for the macro forecast for India, expects 2 more cuts of the RBI to a terminal rate of 5.5. Having said that, even for an economy like India that might benefit from relocation of supply chains and relocation of flows away from the US, we need to understand that things are very, very fluid in the US, and with negotiations on China and Europe in particular. So the landscape today is quite more benign than compared to a month ago. Clearly the rhetoric has softened significantly, so we cannot rule out a different environment a month or 2 months or 3 months from now. So uncertainty remains high, and I think central banks in emerging markets needs to take that into account and move carefully. But in the current environment, even though the Fed might not cut interest rates this year, or at least that's the view that we have, as long as the dollar continues weakening or at least not strengthening from here, there is more room for central banks in emerging markets to continue cutting. India, it's one of them.
Okay, Claudio, thanks so much for joining us on